You've probably experienced this if you've been trading for over a year. Price moves against your directional bias, hits your stop loss, then reverses to your initial direction. So why does this happen? Does it mean your trading strategy is wrong? Or are you a victim of stop hunts? Stop hunts are a way for the smart money to get into their positions at a better price. They will lead you one direction, manipulate price to stop you out, then absorb your position. This will happen to you over and over again until you learn the concepts of institutional Forex and how to see things in the smart money's perspective. Who is smart money? Smart money refers to the biggest and smartest players in the game. They are the central banks, the market makers, and the institutional investors. So it is you versus them. Why and how has the market been manipulated? First of all, individual retail traders do not have a major impact on the movements of price. It is those with the big pockets that move and manipulate price action. Those with the big pockets, like the banks and other big investors, manipulate prices. The manipulation of the market is due to the need for large sums to be filled in the market. For instance, a bank wants to buy $300 million worth of stock. It would be difficult for their orders to be filled immediately, and often they suffer some losses if they simply execute their order like every other retail trader would. What they normally tend to do is to induce some bearish pressure in the market by using a quota of their investment fund, say $20 million. Thereby, creating some bearish sentiment in the market in turn, making traders take short positions so that they would be able to get in at a lower or more discounted price. When price gets to their desired targets, they then place the rest of their $280 million on their intended stock to buy. Stop loss means liquidity. How do you avoid stop hunting? Let's get straight to it. It is impossible for you to say you can totally avoid stop hunting. But there are techniques you can adopt to your trading system to minimize the possibilities of being stopped out. And the major technique is strategically setting your stop loss. Don't set your stop loss just above a major resistance or below a major support. Since liquidity rests above resistance and below support, price tends to move from one liquidity point to another, and that's where most traders place their stop loss. What if I don't set stop loss? Would I fall victim of market manipulation? Looking at this from a logical perspective, you won't fall victim to market manipulation if you don't set a stop loss. But guess what? You may fall victim of losing your whole trading account. Because the market might just totally reverse and never return. What type of trader is more likely to fall into the bait of market manipulation or stop hunt? Most of the market manipulation has negative effects on short-term traders. They are more susceptible to fake news, pump or dump, and so on. So, traders such as scalpers and intraday traders. Do long-term traders suffer from market manipulation also? Yes, of course they do. But they are less prone to the majority of market manipulation. Most times, they do not fall victim to this trap. Does market manipulation occur in all time frames? Yes. Market manipulation can occur in any time frame. But the higher the time frame, the less exposed you are to manipulation. And also, the better your trading decisions will be when you are trading on the higher time frames.